New to investing? These mutual funds could be your first step to becoming a Crorepati. Imagine this. You're about to make one of the most important decisions of your life, and you may not even realize it yet. It's not a bank FD, not a gold or silver ornament, but a method through which you can start shaping your future today. That method is investment in mutual funds. But now the big question arises, where to begin? Which fund should you choose, and how do you take that very first step that could completely transform the course of your life? This is the story of that very journey, where a new investor uses their first bit of capital to build a golden future. A journey that, if started the right way, can lead to a destination worth crores. Today, we'll dive deep into this topic. But before we begin, if you're new to our channel, don't forget to subscribe so you never miss any of our updates. So let's begin today's discussion without any further delay. When we hear the word investment, most people get nervous. They think it's a game for the rich or something too complicated. But the truth is, the sooner you start understanding this game, the sooner you can become a winner. According to 𝐮𝐸𝐿 co-founder 𝐟𝐨𝐥𝐥𝐨𝐰, if you're a beginner investor, you must first understand two things. First, what is your risk appetite? How much risk can you handle? And second, what is your goal? Why do you want to invest money? These two questions form the foundation of your entire investment journey. 𝐟𝐨𝐥𝐥𝐴 believes that if a person clearly defines their financial goals, like children's education, buying a home, or retirement, they've already won half the battle in investing. New investors often don't fully understand the depth of the equity market, so they should begin with caution. An investment made purely out of greed, without understanding the risk, can turn into regret later. That's why before investing, ask yourself, if my money decreases, will I panic? If the answer is yes, then your risk profile is still a bit weak, and you should choose funds accordingly. Now that you're ready, let's understand where to begin. 𝐟𝐨𝐥𝐴 suggests that new investors should have a long-term perspective, at least 5 to 6 years. That's because returns in mutual funds grow gradually, but when they do grow, they can be magical. The journey should begin with a large cap index fund. Why? Because these funds invest in the country's strongest and most stable companies. Here, the risk is lower and returns are relatively steady. You can invest about 50% of your portfolio in these, but large cap funds alone don't complete the picture. Your portfolio also needs a bit of diversification. For this, hybrid funds and multi-asset funds should be allocated about 20 to 30%. These funds invest in both equity and debt, helping to balance the ups and downs of the market. Especially when the market falls, these funds offer stability. They act like a protective shield for your portfolio, like a bulletproof vest. Now comes the talk of a hidden gem that investors often overlook, and that is gold. Yes, investing 10% in gold is extremely important for every new investor. Why? Because when the market falls, gold prices usually rise. It balances your entire portfolio during times of uncertainty in the market. And remember, investing is not just about growing money. It's also about that peace of mind you feel when everything else is shaking but your portfolio stands strong. Now you might think, wow, I get returns and peace too. But wait, there's still one more warning. Small cap and mid cap funds, they are like sweet poison. At first, they look very attractive. The returns appear huge, but they come with a hidden, massive risk. 𝐟𝐨𝐥𝐴 clearly says that new investors should stay away from them for at least the first year. First, understand the market, learn its rhythm, and then, when you feel ready to handle the downturns too, only then step into these kinds of funds. Here's a very simple rule you can always remember. 100 minus your age equals the percentage to invest in equity. That means if you are 30 years old, then up to 70% of your investments can go into equity. The remaining should be put into safer options like debt or gold. Also, your income, expenses, loans, and emergency fund status help determine your risk appetite. If you're investing 1,000 rupees and checking its NAV every day, it's a clear sign you lack patience and have a lower risk tolerance. Now that you understand risk, let's define your goals. The real formula for success in investing is clear goals equals better results. Divide your goals into 3 categories: short-term, 1 to 3 years, medium term 3 to 5 years, and long term 5 to 10 years or more. For example, if you plan to get married in 3 years, debt funds would be a better option. If you're aiming to buy a house in 5 years, then hybrid or large cap funds make more sense. And if your goal is to save for retirement 10 years down the line, then long-term equity investments will be your best ally. Another great method for new investors is SIP, Systematic Investment Plan. It becomes a habit, like paying an EMI every month. The only difference is EMI gets you a product while SIP builds your future. Through SIP, you invest small amounts every month, which adds up to big results over time. This is where the magic of compounding comes into play, something Albert Einstein famously called the eighth wonder of the world. 𝐟𝐸𝐸 also says that new investors should not be afraid of every market fall, because it's during downturns that the best investment opportunities arise. If the NAV of your fund drops, it doesn't mean you made a mistake. In fact, it might be the perfect time to buy more of that fund at a cheaper price. The market never moves in a straight line. It swings, it falls, it rises. You just need to understand that in the long run, the market always goes up. Also, track your investments, but not excessively. Checking your portfolio every week doesn't help. Review it once every 3 months. If a fund is underperforming, talk to your advisor. But panic selling is the biggest mistake in investing. In the beginning, a good advisor or financial planner can be very helpful. They can build the right portfolio for you based on your goals, risk tolerance, and investment capacity. And if you want to learn on your own, start reading bit by bit. In today's world of YouTube, blogs, and apps, free knowledge is everywhere. Just make sure you get it from the right sources. Investment is not magic, nor a way to get rich overnight. It's a discipline, a habit, a mindset. Every small step, when taken in the right direction, eventually turns into a giant leap. Mutual funds can be your most trusted companions on this journey.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources: news from various news agencies, opinion polls, and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.